Welcome to Wyckoff Power Charting. I'm Bruce Fraser. We have a very good show for you today. We're going to do something a little different this time, and we're going to deviate away from Wyckoff, and we're going into a very interesting area of trading using RSI. And we have with us today Andrew Cardwell, and Andrew is we call him Dr. RSI because he is developed a remarkable method for trading with RSI called the Cardwell RSI Edge. And Andrew has graced us with his presence to talk about how to use RSI and use it with the RSI Cardwell method. So anyway, Andrew started his RSI career back in 1978. He is the creator of the RSI Edge trading course. He has students in 28 countries. 70% of his students have been referred by prior students. This is a very popular method, very widely followed. He has a huge following of people that are trading with this methodology. And just make note here on the bottom left, you can see his website, his Twitter feed, and also his email address. So the other thing I want to point out here is that he is prominently in the StockCharts chart school. So when you go to RSI, you do a search on that in the chart school, you're going to see in the second paragraph that they have given Andrew a prominent position in the history of the RSI. And they say here that Andrew Cardwell, Brown's RSI mentor, that's Connie Brown, introduced positive and negative reversals for RSI. In addition to Cardwell, turned the notion of divergence literally and figuratively on its head. So we have a very special session today. And I want to also point out, and we'll come back to this at the end, that this is going to be an introduction today because of the time that we have, but Andrew is going to do a webinar, a free webinar for the TSA-ASF on February 11th, and you are invited to attend. And go to tsaasf.org to sign up, and this will also be recorded so that you can watch it again at a later date. So anyway, with that, Andrew, welcome.
Well, thank you, Bruce. And for those that are listening, I really feel very honored to be called and asked me to do this. He's been a good friend and one of my best students. We compare notes and we compare jokes. And Bruce will tell you sometime about my Druisms, where I come out and say something that just pops into my head, and it may not make a lot of sense, but Yogi Berra used to do the same thing, and I think he's written everyone down.
So our job today is to let Andrew's going to make his presentation, and our job is to identify those Druisms when they fly by, because they're all keepers.
They're all keepers, and I never know what I'm going to say.
Exactly.
And to me, it makes sense. And to others, if you think about it, it does make sense.
Well, Andrew, we're thrilled that you're here, and we're looking forward to your presentation. And so we're going to give you all the time. I'm going to interrupt as little as possible, keep my big mouth shut, and the floor is yours.
Well, thank you, Bruce. First thing, folks, just a real quick note. My first 10 years that I worked with RSI, I did not have a computer. Every afternoon, I took the closing price, calculated the RSI by hand, plotted it on graph paper. I didn't get the first computer until 1988. And for those of us that are dinosaurs somewhat, or seniors, we remember 1987. And the mini crash, when you look at it, looks like just a blip on a chart now. But back then, a 20% drop in one day hurt a lot of people. 20% now, we're talking about a 5,000 point slide in the Dow. So even back then, doing it without a computer, learning the patterns, learning the range rules, learning 70 and 30 is their numbers. The RSI falls between 0 and 100. And most people consider 70 overbought, 30 oversold. They're really just parameters for extension. What I'm going to share with you is, yes, it's used for bearish divergence, but bearish divergence and bullish divergence are not reversal signals. They're only overextensions within the current trend. So we can look at divergence. You can use the RSI for trend analysis, patterns to identify trend change, signal counts, the range rules. I use moving averages on my RSI as well as the close. The pattern recognition section is identifying the patterns that tell you it's either a buy signal, a sell signal, a place maybe to put a stop. And then I combine the range rules. Instead of 70 and 30, I look at 80 and 40 because people by nature are bullish. They understand buy and see it go up and then sell. They don't understand the sell side, because when a market reverses, you want to be out of your longs or at least protecting with stop losses. The trend change, when it takes place, I have this next box there, combining range analysis with moving averages. When the moving average changes the range from uptrend to downtrend, if you think of a market going up, it goes usually up on you walk up a stairway or ride an escalator. But when they reverse, if you're not ready, sometimes it's like taking an elevator to the bottom. They usually tend to reverse twice as fast as they go up. But the most dynamic, unbelievable feature is that bottom box, price forecasting with positives and negatives. It's a pattern that shows that the momentum has fallen, but price does not drop as far as momentum did. And that discrepancy gives me the ability to project the next higher point in the new upside. So it's trend analysis, recognizing and identifying trend change, and price forecasting. So where I say it is a standalone independent model, whether along with Wyckoff, along with Elliott Wave, it doesn't matter. It can be a complement to whatever your trading systems you take to Vegas for gambling. Trading programs, trading plans are what you use to trade markets. Okay, let's have the next one, please. Normally, most people, Wells Wilder's original, I never changed the formula or anything, but Wells would talk about divergence. He would talk about overbought and oversold. I use the words overextended to the upside or overextended to the downside. It's not truly overbought until you see a sell signal. It's not truly oversold until you see a buy signal or buy pattern. And this range, if you look to the right, parameters of RSI, 0 to 100, normal range, 70 and 30. Number two, that's where most of the activity takes place. But when it goes up above 70 and hits momentum highs up at 78, 80, 82, price is making a higher high, RSI's made a higher high, and the range has shifted. Now on the downside, when it breaks 40, it's changing and breaking the bull range. The bear range number 4, same concept. If it can't get back above 60, you're in a downtrend. If it breaks below 20 or reaches 20, you're overextended. So if you want to define overbought and oversold and use those terms, look at 80 and 20, but understand what those first numbers 2, 3, and 4 really mean. The midpoint, a lot of people say, well, I'm buying it because it's RSI is above 50, or I'm selling because it's below 50. It's not necessarily the case, because sometimes we'll go down through 50 and put in a long-term positive reversal pattern. And I take those positive reversal patterns and find the 2 points on a bar chart, and I draw a line, which I call a positive reversal trend line. And as long as price action stays above it, it further confirms the trend is still going. Where these patterns take place on a chart tells a lot. So it's a very extensive, I mean, like I said, I did not have that computer and every afternoon plotting a RSI value for a specific market. I think I was following 10, 12, or 14 of them. Gold, crude oil, currencies, bonds, yields, stocks, stock indices, cross rates. You can use it on any market. You can use it in any time frame. I have students and clients in 28 countries around the world. So how many markets do you think that I have to look at, you know, when they call and say, could you pull the chart up and tell me what's going on here? So any market, any time frame. The shorter the time frame, the more volatility you're going to see. But always remember to look at one time frame longer, at least one or two, longer than what you're trading, because that's going to be the underlying trend. When that short-term chart of an hour shows a positive reversal or support at 40 after it's been up to 80, you should see it go back up. If the dailies are staying above 40, the trend is still there. If the moving averages, the shorter term on the RSI, I use as a simple 9 on a RSI 14 and an exponential 45. But if the 9's above the 45 on close and above the 45 on RSI, the trend should be up. That's just basic, like these range rules. But I have many students and clients who are even trading mutual funds based on just the range rules. As long as it stays above 40, they're in it. If it breaks 40, trend is changing, but you'll notice that because it'll have problems getting back on rallies above 60. The higher the positive reversal patterns show up in the RSI, the stronger their signal. I've seen it go to 80, 82, sell off to 70, back to 75, make a bearish divergence. And most people who follow RSI say, well, it had a bearish divergence, so I sold it. Well, it sold off the next time into a positive reversal and blew right through that 75 level. So you have to understand, and I have a chart to show you which one. You will see a bearish divergence followed by a negative reversal. You'll see a bullish divergence followed by a positive reversal. Let's go to the next one, Bruce. This is one just for range rules. In section A, in that block A, if you see all the activity on the RSI is running between 80 and 40, you look at your bar chart, your moving averages on close will probably still be pointing higher. I don't have to wait to see the 50-day moving average cross the 200 to tell me something's changed. When I was in Vegas, I spoke at the Money Show and I put this chart up, and one fella came up afterwards and he said, your range rules are unbelievable. I spoke to him the day after I presented my lecture. He said, I went back and checked a lot of charts and I had some that I was losing money in. It was in that 60, wasn't going above 60, never broke it and kept going to lower prices. I said, well, you should have recognized it. He said, I did after I looked at your range rule chart. So that shift from A to B tells you there's a possible trend change taking place. If you've made a low on down in block C, sometimes it won't get to 20. It'll stop at 30. But if it breaks 30 and the RSI is still falling, then you're going to see further downside.
Okay.
With the range moving average, say the 9-period moving average on RSI, this is seeing the trend. If you looked at that RSI, this could be the 9-period moving average of RSI. It turned up, it went above 45, it went above 50. When it broke in that 55 range, then you can see the short terms turned up, the intermediates turned up, and the intermediate to long term is turned up when that 9 moving average goes above 60. So that's where I said I combined the moving averages of RSI with the range rules. In the lower left, it says begins upside acceleration. Well, the RSI will break that 60 level, and then you see the 9 break it, and it might go up and make a bearish divergence. And everybody says, oh, it's time to get out, and they get out. So many people get out near a top that's just a trading top. The longer term trend is still to the upside because the range rules and now the moving average of RSI has crossed 60. saying you're just starting upside acceleration. And I've even put simple 20-period moving averages on RSI, and I've put 45-period simple. And if that 45 goes above 60, it could stay above it for a while. On the right-hand side, the market is turned down, the RSI is turned down, and the moving average is turned down. So when it breaks below 40, the range has shifted, and most of the activity should be down between 40 and 60, or between 60 and 20. So on the rallies, if it rallies, and we'll go to the next slide, momentum high divergent counts. It's what I call the X point, which is our highest momentum high in the RSI. Or if it gets down near a low, it's the momentum low, but it can bounce and then go to a lower low. So your trend is still there, or it can rally and take out the momentum high and make a new one. So bullish, bearish, positive reversal, negative reversal. Remember bull and bear. If you see, we'll show the next slide, but if you start to hear somebody say, well, I see a bullish divergence. If you look on the left upper chart, that's your signal count. X is a price where it closed. 2 days later, 2 periods, 2 hours, 2 months. Two periods later, it closed at a lower price. Look at your top middle. It's an RSI chart where I just put numbers on there. 100 was a momentum low, a bounce to 104, a sell-off to 99. You look to the far right, top chart, up one. I put dots between them. I should have made them solid lines. But it rallied 1 period, sold off the next. That's a 2-period signal. Sometimes it'll rally 2 periods in a row to the up and have 2 to the down, but starting that count at the X point, it's still within the 2 to 5 period. The tighter the signal, the stronger. And if this upper right chart turns out to be a real divergence, bullish divergence, you're going to see what looks like a positive reversal. And we'll discuss that. The bottom, same thing, points X1 and 2. It rallied to 100, sold off, rallied back to 103, closed higher. And the chart on the lower right is a 2-period bear. So let's go to the next one. Upper left, bearish divergence. This is what everybody falls into, a false set of comfort. Oh, it's a bearish divergence. I need to get out. They get out expecting to see the market sell off. Well, it did sell off, and then it came back up to 123, created that divergence, and then it went down to 117, which took out the point took out the price 118.1. Then it bounced to 120 and then lower. Now look at the right-hand side, top right. It rallied to 123. It sold off to 120. Then it rallied to 121. Well, the RSI rallied, but price did not go to a new high. So it became more, and this is why I use the word overextension. It became more overextended at a lower price. Basically, it used up all the momentum it had and it couldn't make any price advance. If you take X minus 0.2, 123 minus 121, look at the math I did. X minus 2 equals 2. 123 minus 121. You're going to target 119. It achieved it. If you look at the next one, 118, it's 118 minus 2. It's going to give you a target of 116. Before I say something about options, I want to finish the bottom here. Bottom left, bullish divergence, 117 versus 115, 2-period bull divergence. Now look at the chart on the lower right. It was at 115. It rallied to 119, up 1, down again, and yet RSI went lower, but price was still greater than it was at 115. And anybody that can add and subtract can learn positives. I can teach you. That difference of 3 points is then added to the 119, and it's also going to be added to the 120. Now, the beauty of these patterns is whether it's a positive or negative, once you set that target, if it's a sell on a negative, then it's going to set a target on the downside. And when it closes below it, it confirms the trend change and says, now you're in a downtrend. Bottom right, if it confirms it on the upside, sometimes it'll come up very close to what your target is and not achieve it a day or two, but then go through it and close even higher. And this is where I said people get caught with bearish divergence and say it's over. If it's a positive and you sell into a positive reversal, you're going to understand what pain is, because the market can do the most it will to confuse the most people the most often. And markets don't care what happens to your money. But let's look at the next one. This is my favorite of all times. I was sitting somewhere having a cup of coffee one day, and I said, let me see if I can draw this out. My son told me, call it the ABCs of RSI, because when I realized I had about 26 points, I said, that's fun. And trading should be fun. You shouldn't stress in your trading. If you're stressing while you're trading, then you don't know what you're doing. Because when I teach the way I approach it, the way I've learned it and taught myself, and I was lucky when I started to find people like John Murphy, Walt Bressert, Martin Pring, Joe DiNapoli. I got to meet a lot of the guys when I first started and I first spoke. I think the very first lecture I did was in New Orleans, and sitting in the back row with my wife at the time were John Murphy, Tom Asprey, Martin Pring, and I believe Walt Bressert was there too. And after I finished, I went back there and I said, well, guys, how'd I do? They said, whoa, you acted like you've lectured for years. I said, I was scared. It's the first time I'd ever talked to that big a group. Well, the next day they asked me to do another replay, and I probably told different jokes the same day, or I had different Drewisms. Who knows what I'm going to come up with. But this chart, if I tried to mark it starting just A and C as a bullish divergence, then a rally to 145, then a sell-off to 142, and then a new high point F at 155, and then a sell-off to where I marked it, letter G, 148, PR, positive reversal. Look at G versus minus E, 6 points, add 6 points to point F. That says 161. Then it sold off from H to I, but it never achieved 161. But 157 was still above the previous high at 155. What was a top became a bottom. Then it rallied, it achieved the 161 target when it went to J at 163. Sold off into what? Another positive. Once you see that first positive at letter G, that's what confirms that first bullish divergence at A to C is real. But if you're in a downtrend, you're going to see multiple bullish divergences, and each one's going to rally and fail and start down and make a new momentum. The trend's down. So in a downtrend, you're going to see bullish divergence. And then when it starts up, if you see a positive, you probably have some sort of bottom in there. Now, before I go on to anything else real quick, there's 4 basic components: price, momentum, time, and sentiment. The RSI is a sentiment tool too, because it's giving you a perspective of how traders are viewing the markets. Is it staying in the lower half of the chart on RSI, the lower bear range on the range rules, or is it staying in the upper half? So it's a good sentiment tool too. The price analysis, I do a whole section on price analysis, and a lot of people follow pivot points or swing points. Well, I do also. But I want to finish this chart just by saying that positive had a target. We lost it.
Uh-oh.
Okay. Somebody pulled the plug.
I forgot to pay the bill.
I'll PayPal you. So when that's at that next target, 2 points difference, I and K, we're looking at 165. And do you see what happens? It goes, and it may have had a couple squiggles along the way, but it achieved 165 and kept going, got to 170. At point L, you're at momentum high. Sell off to 165, up to 174, bearish divergence. Now watch this. Sells off to O. Look at O versus M, and I put 2 little gold stars in there. It shows a positive reversal with bearish divergence, bearish divergence. When you see a bear divergence and a positive, the trend is still up. The same as if you see bullish divergence, and when we get over here to the right with negatives, it says the trend's still down. So we had the bearish divergence on momentum high at L, bearish divergence at 174 N, and then it got to 175, but the difference was 3 points to 174. It should have gone to 177, but it failed to do so. Then it dropped to Q, and it rallied to R. Then it went to a lower low at 157. But think about what happened with the positive of M and O. It failed to achieve the target on the upside. So when you set a target on the upside, it's a resistance point in the future. If it closes above that level, it's confirming. If it can't get through that level, then it's failing. And Jeff Kennedy and I always talk about this. The best sell signals are failed buy signals. So it's a little thing you can carry around and think from time to time. The negatives I marked in red. It's a rally where the RSI goes up. Letter T versus 170. You subtract the difference at 157. So when you see letter T in a negative reversal, the price is 168 and you have a target of 155. I have option traders that love this for options. And then it was confirmed with another negative and then a range shift to the downside. So I appreciate the fact that Bruce and I could have some time. I could introduce myself. John Bollinger gave me the name Dr. RSI. My first name's Andrew. And if you want to get in touch with me, you can go to the website, the Cardwell RSI Edge.com. Please do not respond email to the website because we're having a slight problem with it. That's why I wanted to put in the trader 011 at msn.com and let you know that, there you go. That 011, if you're familiar with it, it's an international calling code. And that picture is my younger twin brother. But I'm here to help. Like I said, it works in all markets. There's no limit to what it can.
You have some great content on the website. People should go look at that. And then also they should come to the webinar.
Oh, absolutely, because when given an hour, I have time to pull up charts.
Right. And so we're going to look at current markets, past markets, and more case studies. Thank you so much. We're going to do this again. We're going to do it right here. We're going to have more RSI with Andrew Cardwell and Dr. Andrew. Thank you so much for your time.
Is your portfolio positioned to profit from continued market volatility in 2019? Join over 100 investing and trading experts, including policy guru Steve Forbes, emerging markets icon Mark Mobius, America's best income investor Bruce Johnstone, elite energy analysis Stephen Schork, and trading visionary Tom Sosnoff at The Money Show Orlando to get the best ideas for protecting and growing your investment portfolio during 250 in-depth presentations. Claim your free pass now at orlandomoneyshow.com.